So we've seen a surge of issuance this year too. So this is almost the third year. We're on pace to actually break last year's record. So we almost are looking at about 300 billion in the first half. If you annualize that, kind of street estimates are close to 600 billion. So that has been a major headwind. But I think the difference this year, now keep in mind, we just gave back a good amount of performance in July. Right. So the broad Muni index was down, about 1.8%. We're slightly positive now for the year. So we gave a lot of it back. A lot of that had to do, though, with the Treasury rate volatility, right, in the movement there. So this was not a credit issue. And then again, Treasury rate volatility coupled with supply, that's what's really kind of created this negative overlay for munis. But again, I think when you look at the technicals, it's about supply, but it's about how can that be absorbed. So then it's also demand. So demand has actually been fairly robust this year. So if we see that trend continue, that can help absorb some of this supply, which is very different than what we saw last year where demand wasn't keeping up with the amount of supply the market saw.
But all that being said, though, absolute yields are on a tax-adjusted basis are really attractive for a lot of people, right? Like
yes.
People in high tax jurisdictions
yes.
like New Jersey.
Yes. Yes, that's exactly right. So we were seeing that already before this recent repricing. Now, where we see, I would say the curve remains very steep, right? Especially relative to the Treasury market. So you're getting paid to take on duration. The belly of the curve, though, particularly has sold off the most so far this year. So think about that as a 10-year part of the curve.
Okay.
A lot of the issuance has been in that part of the curve. So that part of the curve has sold off even more than the long end.
Right.
So now, before you had to maybe go out 15, 20 years to get, I think I don't want to say get paid for a duration, but to really find that
right.
relative value, you don't have to go out that far. So your 10-year bond, New Jersey, let's say roughly 3.5% yield, high tax state, you're looking at, kind of 6.5%, 7% all in,
mm-hmm. right.
which is extremely attractive. So as we talk about this equity melt up, Tom, 7% locked in, high quality bonds,
right.
That looks very attractive on a risk-reward basis, in my view.
Right. How is Parametric different from the big houses in muni bonds? What are you people doing exactly?
So two things. We separately manage accounts. So what that means is each of our accounts are customized. We manage roughly 90,000 different accounts. So Tom, you give us an account. Paul, you give us an account. You give us a parameters around what you want us to invest in. So it'd be New Jersey for you.
And you go
Tom,
out and find bonds.
Correct. Now,
right.
we do ladders. You talked about laddering. It's a great way to take beta exposure. But we also do...
Wait, they were a great band. Beta Exposure, they played Devo like nobody. What in God's name is Beta Exposure?
Well, that means, look, you can't match the index perfectly in munis, right? It is very tough to recreate a muni index. But by saying, hey, I would like a, let's say, 1 to 10-year ladder, New Jersey specific, we can create that market exposure to munis. Now, we can also manage to a total return component. But bottom line, Tom, the number one thing that we are doing is customizing these accounts for our clients. Number two, munis are already inherently tax efficient. We are overlaying this with a component of tax loss harvesting. So Parametric manages over $750 billion across equities
right.
and fixed income. Tax loss harvesting is another element of tax efficiency that we can create for our clients at Parametric.
Yeah.
How's credit quality out there in the municipal bond world? I don't hear any stories like Chicago or Puerto Rico blowing up and causing all kinds of problems. How's credit quality out there?
Credit quality is fairly stable. And look, I would say boring is okay, right? So, but I think you have pockets in certain areas, in certain sectors that you do see a little bit more credit bifurcation. So private education, I would say healthcare, in the lower quality space, obviously you want that credit oversight, right? Making sure you're getting paid for that additional yield. But think about the economy, right? I mean, the economy's been fairly strong. Tax collections are strong. So you're looking at a fairly robust profile generally across the board in the investment grade space. Now, you may start to see headline risk. Now, I would say you're seeing that with some states, with some cities, dare I say New York City, given the budget gaps, right, that are projected, some of the one-time measures they're considering. But we remind our clients that fundamentally, the credit remains strong. Headline risk is very different than the ability to repay debt. And this still remains a high quality issuer in our view.